Everyone, good afternoon. I hope you people can hear me and see me. Well, good morning, Sarah. We have afternoon here, so should we start? Well, the beauty of this webinar, we have good afternoon messages, we have good morning messages, and we also have good evening messages. Okay, let's start. Well, we were discussing uh, options in our last class. Let me give you a quick recap of the options that we discussed. We can use options as a hedging technique. What options are actually? Options when you say, for example, let me explain it through an example. Mr. A needs $1,000 to pay to its foreign supplier. Local currency, suppose it's Pakistan rupees, RS, Pakistan rupees. Suppose it has to pay $1,000 after 1 month, but Mr. A is not sure whether he will be paying to the supplier or not, because he's not sure of whether he will accept the quotation of this foreign supplier or not. So he might be going to pay $1,000 after 1 month, or he might not be paying, so you're not sure. So definitely, if you're not sure of whether you're going to make a payment or not, you cannot enter into a forward contract, or you cannot go for any future trading, because for a forward contract it needs to be closed out on a specified date, and even for a future contract it needs to be settled somewhere in the future. So the best in this case, the best hedging technique will be to go for options. Now, how does it work? Mr. A, it will go to the bank and ask for options. Suppose that the current spot rate is rupees 100 per dollar. So it's quoted in a local currency, and whenever an exchange rate is quoted in local currency, it is called direct quote. Remember this. I hope everybody is aware of it. So it's called direct quote. Whenever the exchange rate is quoted in local currency, it is called direct quote, and whenever it is quoted in a foreign currency, it is called as indirect quote. So for Mr. A, the local currency is Pakistan rupees, and the exchange rate, since it is reported in the Pakistan rupees, is called direct quote. So this is the current spot rate. Now, quickly answer me. What will be the concern for Mr. A? Will it be the exchange rate going up or coming down, going down? What will be the concern for Mr. A? What he will be afraid of? Going up, exactly, because Mr. A has to buy the foreign currency, because he has to make a payment. So he has to buy foreign currency so that it can make payment. So at the moment, $1 has equivalency of rupees $100. So Mr. A can buy $1 for 100 rupees. So the concern for him will be that maybe in 1 month's time this rate might go up and he has to pay more in local currency than he can pay now. So what he will do is he will go to the bank and will ask for cap option. What does that mean? He will just fix the upper limit for this exchange rate with the bank. Say, for example, the bank puts a cap on this exchange rate of 101 rupees per dollar. So the bank has committed with Mr. A that it will supply these $1,000 for 101 rupees per dollar in 1 month's time, irrespective of what the exchange rate will be in the open market. So Mr. A has actually purchased the cap option. So against purchasing this option, at the time of purchase of this option, that is today, Mr. A is supposed to pay a premium. Say, for example, the premium is 0.5 rupee. It's a 0.5. So it has to pay 0.5 per dollar. So multiply by 1,000, you'll get the total amount that he is supposed to pay as a premium. So he'll pay that. Now, after 1 month, Mr. A, if he needs to purchase these $1,000, will go to the bank and will be paying 101 against each dollar to get these $1,000. It has already paid the premium, so it has to pay this rate to the bank to get these $1,000. Now, what will happen if this rate, the open market rate, is 103 per dollar after 1 month time? So Mr. A will not go to the open market, it will go to the bank and buy it for 101 rupees per dollar, because the bank has given him the right to purchase these dollars for 101 per dollar. So by getting this option, yes, Mr. A will get the benefit. Now, what if the rate in the open market goes down? Say, for example, it goes down to 97 per dollar. And if Mr. A still needs these $1,000 after 1 month time, he will not go for exercising this option, because if he does so, he will lose, because he can get the same dollar for 97 rupees. He won't be going to pay 101, and since it's an option, he has the right not to exercise this option with the bank. So he will just go to the open market and buy it for 97 rupees per dollar. But remember, he won't get this premium which he paid at the time of purchasing this cap option. He won't get this back, but he has all the rights in the world not to go and exercise this option. He will just go to the open market and get it for 97 rupees per dollar. Yes, he has already paid the premium, and that's the cost that he has given against securing his risk. So he avoided the risk and he has paid something. Definitely, if you get an insurance against your car and you don't get an accident throughout the year, you still have to pay the premium, because the premium was not to avoid the accident, it was to avoid you from the financial loss due to that accident. So you still have we would have still paid that premium. So the premium is the cost of not taking the risk. So this is the cost of not taking the risk. The benefit for the bank is the premium that he has got from the customer at the time of selling the cap option. In case of payment, depreciation of currency is unfavorable and appreciation of currency is favorable. Well, depreciation of which currency? Foreign currency are talking about. So if you are going to pay and the foreign currency depreciates in value and you have to pay less in local currency, definitely yes, it's a favorable one. If they pay premiums, or yes, the payment will be paid upfront at the time of purchasing the cap option rather than exercising this cap option. 1,000 into 0.5. Yes, yes, Yesha. It will be a 0.5 into $1,000. So this is how options work. Yes, PKR 500, Shiraz, you're right. Okay, let's move forward. What if Mr. A is expected to receive $1,000 rather than paying $1,000? Now it's a payment, it's a receipt case. So for a receipt case, Mr. A will never be worried about the exchange rate going up. It will benefit Mr. A. If this 100 rupees go up, say to 103, this will be the benefit of Mr. A because he's going to receive a foreign currency, and if he converts this foreign currency into local currency, he will get more of local currency. So it will be a benefit for him. So the concern here will not be that the exchange rate will go up. The concern here will be that the exchange rate might go down in the future, and Mr. A will receive less than what he can receive today. So in that case, he will never go to purchase cap, because if he goes and purchase a cap, it will be he will be at loss. So he will never get a cap. What he is going to do is he is going to purchase the floor option. So he will purchase the floor option. So he's not going to purchase the cap. He's going to purchase the floor option. So he will go to bank and ask for a floor option and fix a minimum rate. Suppose the bank has guaranteed a rate of, say, rupees 99 per dollar. The bank has guaranteed that after 1 month's time, Mr. A will get 99 rupees at least against every dollar that he exchanges. So he will get 99. So Mr. A at point 0 will be sure that his total receipt in local currency will be after 1 month. So he has no more risk involved. So he'll be sure that the minimum 99 rupees he will get against exchanging $1. But again, since he has to purchase this floor option, he has to pay a premium, say the same premium, rupees 0.5 per dollar. So he has to pay at the time of purchasing this floor option 0.5 per dollar, that is 500 rupees against these $1,000. So what will happen now? Suppose that the open market rate goes up to 103 per dollar. What do you think? What's good for the Mr. A? Floor option means the minimum rate. So what do you think? Should he go to the bank and exchange it for rupees 99, or should he go to the open market and purchase it from the open market? Open market, right? He should go to get these converted in the open market rather than going to the bank and just getting 99 rupees. So he will not exercise, he will leave this option. He will not exercise and go to the bank. He will go to the open market and get it exchanged for 103. Yes, so in case of foreign currency receipt, Ubaidullah, for a foreign currency receipt, whenever a company or an individual is expecting a receipt of foreign currency, he will, if he wants to hedge his risk by purchasing the options, he will go for floor option. But in case any company is expecting to make a payment in foreign currency, they will go for cap option. Yes, Sikandar, cap is the upper limit and floor is the lower limit of an exchange rate. A put option and call options, uh, well, the same floor option can be called, say for example, what Mr. A is doing. Mr. A will be selling this foreign currency to bank in order to close this transaction, right? To close this option, Mr. A has to sell this foreign currency to the bank. So whenever Mr. A has to close its transaction by selling foreign currency to the bank, it is called put option. So we can say it's a put option. Yes, it's a put option. But when Mr. A has to close out this transaction by purchasing the foreign currency, it has to set the upper limit, which is cap. And since it will have to close out the transaction by purchasing the currency. So when you close out a transaction by purchasing the currency, it's actually the call option. You're calling for the currency, so it's a call option. So if in the open market the rate goes up to 103, he should not exercise the option and he should go to the open market and exchange it for 103 rupees. On the other side, if the rate after 1 month goes down to 97 rupees per dollar, what should he do? What should be done then? What should be done then? Should he go for exercising the option or he should go into the open market and exchange it? Yes, he should exercise the option and he should go and purchase the sell the currency to the bank rather than selling it in the open market. So that's how it works. So let me now explain one more thing. Taking the same example again for the receipt, for the purchase of the currency. Let's take it for the purchase of the currency. Let's say Mr. A has to purchase the foreign currency from the bank, $1,000. Suppose he has to purchase. So what will be his concern? He will be concerned about the rate going up. So he will go and purchase, say for example, he will purchase cap option, or we can call it call option. Okay, and he is supposed to pay 0.5 rupees per dollar premium. So the premium will be now 0.5 into 1,000, that is 500 rupees he has to pay as premium. Now Mr. A wants to reduce his cost. Listen carefully, everyone should listen carefully. Mr. A wants to reduce its premium cost because he feels that the cost is very high. That's 0.5 into 1,500 rupees. So he wants to reduce this cost, at the same time eliminating the risk but reducing this cost. What can he do? Now, if the rate goes up, whose risk is this? Is this the risk of the bank, or is this the risk of Mr. A in case he has purchased the call option? Tell me. No, it's no more the risk of Mr. A, because if the rate goes up, he has already purchased the cap option, the upper limit. Say for example 101. The bank has guaranteed to provide this currency for 101 rupee. So even if the rate goes up, Mr. A has to pay 101 rupees per dollar. So the risk has been shifted to the bank, and that's why bank has asked for a premium. Okay, now what if the rate goes down? Who will benefit from it? If the rate goes down, Mr. A? Yes, Mr. A is going to, no, it's not the bank who's going to get benefit now. It's Mr. A, because if the rate goes down in the open market, Mr. A will leave the option and will go and purchase it from the open market at a lower rate, so he'll gain. He will get something for a lower value than he has decided with the bank. So he will gain from it. And the bank is going to lose. So now what? Suppose that Mr. A tells the bank that let us fix a lower rate as well. And that is, say for example, that is 99 rupees per dollar. That's called floor, right? Okay, let's set a floor value as well. And what does that mean? Well, it means that if in the open market the rate goes down to 98 rupees, Mr. A will still buy it from the bank at 99 rupees. 99 rupees. So Mr. A has committed this with the bank that if the rate goes down to 98, I will still buy it from 99. Okay, who is going to get the benefit of it? If the rate goes down to 98 and Mr. A fixes it with the bank that he will purchase it for 99, not instead of purchasing it from the open market for rupees 98, he will purchase it from the bank for 99. So what do you think, who is going to get the benefit? Yes, the bank is going to get the benefit. Now by fixing this rate, the bank will get the benefit. So what do you think? Mr. A will pay for this floor option, or bank has to pay Mr. A for this option? Who is the beneficiary of fixing this rate? Bank has to pay, because the beneficiary is the bank this time. If the rate goes up, the beneficiary will be Mr. A, because he still has to pay 101. But if the rate goes down to 98, Mr. A has to pay 99, so Mr. A will be at loss of 1 rupee. So it still has to pay 99. So the bank will be at the benefit side. So this time bank has to pay premium. That is, bank will be purchasing the floor option. Bank will be paying for the floor option. So Mr. A has actually involved in a transaction, listen carefully, has involved in the transaction in which it is purchasing cap from the bank and selling floor to the bank. So for against cap it will be paying, and against the floor it will be receiving. Suppose that he's paying 0.5 for buying the cap option but receiving 0.2 rupees per dollar by selling the floor. So if he's involved in this transaction, what will be his net cost of hedging per dollar? Per dollar. Tell me the per dollar benefit. 0.3. Yes, the net cost per dollar to Mr. A will be 0.3. Okay, tell me, has this transaction reduced Mr. A's cost of premium? Has it reduced? Yes. And what he did actually, he purchased the cap option and simultaneously he sold the floor option to bank, and he has reduced his cost to 0.3 rupees per dollar. And if any customer or company gets into such transaction, it is called collar transaction. It's a collar transaction where cap and floor is simultaneously purchased and sold to reduce the premium cost. This is called collar transaction. I hope I've explained it. It's a collar transaction. Mr. A purchased the cap option from the bank, paying 0.5 rupees, and then selling the floor option at the same time to bank for 0.2 rupees. So the net cost, he paid 0.5, received 0.2. The net cost is 0.3 rupees per dollar. This is called a collar transaction. Shiraz, yes, you can say, but the whole overall process is called a collar transaction. The whole process is called a collar transaction, where the purchase and sale of collar of cap and floor take place. It is called a collar option. Simran, okay. Mr. A fixed upper rate with the bank so that it needs not to pay higher than this if the open market rate goes up above 101. So it fixed a rate with the bank, the upper limit with the bank, so that Mr. A is sure that he will never pay more than 101 even if the open market rate goes up. Since the bank will have to bear the loss, because in the open market the rate will be 103, but he will be selling his currency for just 101, so the bank will be at loss. Therefore the bank has asked for the premium. So Mr. A, while fixing the upper limit, will have to pay 0.5 per dollar premium to the bank. But at the same time, Mr. A offered the bank that let's fix the lower limit as well. And what does he mean by saying this? He means by saying this, he tells the bank, if the open market rate goes down to 98, that is, even if I can have a dollar for 98 rupees in the open market, I will not go for it and I will buy it from you at 99 rupees. That is the minimum rate. So let's fix this rate, 99. And if in case the open market goes down below 99, I will still purchase these dollars at the rate of 99. Since this time the bank will get the benefit of fixing this rate, not Mr. A, because Mr. A is going to lose. Even if the market has a rate of 98, it will still be paying 99 rupees to the bank. So this time Mr. A will be at loss if he fixes the lower rate. So Mr. A tells the bank, just let us fix this rate and purchase this floor option from me for rupees 2.2 per dollar. So the bank will pay Mr. A 0.2 rupees per dollar against purchasing this floor, but will ask for 0.5 rupees per dollar against this cap option. The cap option is giving benefit to Mr. A, the floor option giving benefit to we're giving a benefit to the bank. So Mr. A on one side has to pay 0.5 rupees by purchasing the cap. On the other side, it will receive from the bank 0.2 rupees against selling the floor option. So his net cost of net premium cost will be 0.5 minus 0.2, that is 0.3. And selling floor and cap, selling and purchasing floor and cap simultaneously is called a collar option. Sir, the rupees 0.3 dollar premium hedging is called the collar option. Yes, the whole process is called collar option. The cost of this collar option will be 0.3 rupees per dollar. Is it clear now? Can we use floor for call option? Like we used for the call option. Yes, for the floor we call it a call option, and for the cap we call it as a put option. Yes, risk management will not be examined in the descriptive section of the syllabus of the paper. Well, it's for both, because what Mr. A is selling, Mr. Bank is buying, and what Mr. A is buying, bank is selling. So it's a collar option for both. So both are involved. If you go and buy a cell phone, you've actually bought a cell. but you have bought the cell and supplier has sold the cell phone. So on both sides it will be called the same. So it's a caller option for both, for bank and for the customer. Yes, Mariam, I will share my WhatsApp number by the end of this session. So do remind me at the end as well. Section C, yes, Sikandar, section C, in which you have to write. Yes, point 2 will be paid premium by the bank. So should we move forward? Should we move forward? Okay, let's discuss currency swap. Now we have another option that is called currency swap. Do listen it carefully. Currency swap. What is currency swap? I will explain it through an example. Suppose there's a company in US and this company is intending to invest in Pakistan 1 lakh rupees. And there's a company in Pakistan which wants to invest in USA rupees, sorry, 1,000 US dollars. 1,000 US dollars. Now, what the company in Pakistan has to do, it has to go to the bank in Pakistan, borrow these $1,000, sorry, borrow Pakistani rupees, convert it into dollars, and then invest in US. And the same process will be done by the US company. It will have to go to US bank, borrow in dollars, convert it in Pakistan rupees, and invest in Pakistan. Invest in Pakistan. Suppose that the current exchange rate is rupees 100 per dollar. So how much Pakistan company, the Pakistani company, has to borrow from the Pakistani bank? How many rupees? This diagram I'm just explaining. It's not a diagram. I'm just explaining. A US company wants to invest 1 lakh rupees in Pakistan. It has an investment opportunity in Pakistan, and it intends to invest 1 lakh rupees in Pakistan. And there is a Pakistani company which wants to invest in USA an amount equal to $1,000. So what Pakistan bank has to borrow in Pakistani rupees to get $1,000? So it has to borrow 1 lakh rupees, and once it borrows 1 lakh rupees, it will convert it into 1,000 because the exchange rate is 100. So 1 lakh divided by 100 is equal to $1,000. So it will convert it into $1,000 and invest in US. On the other side, the US bank has to borrow how much? How much does the US bank will borrow? How much will the US bank borrow? It has to borrow from its local bank an amount equal to $1,000. Yes, $1,000. And it will convert by multiplying 1,200 to get 1 lakh rupees and invest in Pakistan. Now what will happen? Every year, the US company who has invested in Pakistan will get its return in Pakistan rupees. And the company based in Pakistan who has invested in dollars in USA will be getting its return in the form of dollars. So both companies will have to convert the currencies into local currencies, and every year they will be exposed to exchange rate risk because they have to convert it and then pay their interest payments. Now, Pakistani company has to pay interest in rupees because it has borrowed in rupees, but its income will be in dollars. So every year it has to convert the dollars into rupees to pay its interest. So every year it will be facing the risk of exchange rate fluctuation. And the same case will be with the US company. I hope you have understood the problem. So how to reduce this risk? How to reduce this risk? Just listen carefully. Pakistani bank borrowed 1 lakh rupees. The US bank borrowed $1,000. What Pakistan bank has to do, it has to convert these 1 lakh rupees to get $1,000. And what the US bank has to do, it has to convert $1,000 to get 1 lakh rupees. Now the best solution will be that the Pakistani bank should, instead of converting it into the open market, should hand these 1 lakh rupees over to the US bank, and the US bank in exchange of these 1 lakh rupees should hand over these $1,000 which it borrowed to the Pakistani company. So they should swap these currencies. The Pakistani bank should give these 1 lakh rupees to the US bank, and the US bank should give these $1,000 to the Pakistani bank company. Yes, inter-country, you can say these two companies might be subsidiary of parent companies, and they might exchange like this. So they will exchange, swap the currencies with each other. Now, what next? US company received 1 lakh rupees from the Pakistani company. The Pakistani company received $1,000 from the US company. The Pakistani company will now invest these $1,000 in USA, and the US company will invest these 1 lakh rupees in Pakistan. So the investment has been done without converting the currencies. Without converting the currencies, just they swap the currencies with each other. Mustahsan, just hold your horses. You will understand the purpose, the logic behind this. It is happening between two companies who are in need of reciprocal currencies. The US bank needs Pakistani rupees, and the Pakistani bank, so the US company needs Pakistani rupees, and the Pakistani company needs the US currency. So it's a swap between two. It might be between two different companies, or it might be between within the group. It means a parent might swap the currency with a subsidiary as well. So they have swapped the currencies with each other. Okay, now what will happen? After 1 year, the Pakistani company will get its return in the form of dollars. Its return will be in dollars. Its return will be in dollars because it has invested dollars. So what it has to do is, of the 1,000 of the return that it has got after 1 year, it will be asked to pay the interest on the loan of $1,000 which the US bank borrowed and handed over to the Pakistan company. So the US company, so the Pakistan company, say for example it's B company and it's A company. So the B company, whose return will be in dollar, has to pay the dollar loan interest rather than the Pakistani loan interest. So out of its dollar income, it will pay the interest in dollars on the loan borrowed by the US bank. And on the other side, the US bank, whose return will be in Pakistani rupees, the US company whose return will be in Pakistani rupees, will be paying the loan on, will be paying the interest on the loan of 1 lakh rupees. So what will happen is every year company B will receive its income in dollars and will pay interest in dollars, and it needs not to convert its currency to pay the interest. And the US bank will receive its income in rupees and will have to pay the interest in rupees. So every year they will be able to net off their receipts and liabilities, which will be in the same currency. After, say, for example, the investment was for 3 years. Suppose that the US company sold its investment for the same amount it purchased, that is 1 lakh rupees, and suppose, assuming that the value of investment has not changed. So it sold its investment for 1 lakh rupees, and B company sold its investment for $1,000. Now they have to, if they are not involved in, if they were not involved in the swapping, what they would have been doing, the Pakistani company, by selling these $1,000, this company was supposed to convert these $1,000 into rupees, and whatever the exchange rate in 3 years time will be, that will be the rate for them, and they might lose in converting these $1,000 in 3 years time. Same will be the case with the US company. But because they swapped the currencies, now what will happen? Pakistani company, B company, sold its investment for $1,000. The US company sold its investment for 1 lakh rupees. Now they will swap back the currencies with each other. The US bank will hand over these 1 lakh rupees to the Pakistani company, and the Pakistani company will hand over these $1,000 to the US company, and they will swap back these again, and each of the two companies will get the same amount of local currency which they swapped 3 years ago. So no change to their values of investment because of the change in exchange rates. I hope you have got it. This is what currency swap is all about. Hello, am I audible now? Okay, yes, the mock debrief will be today. Just we'll be discussing the money market hedge, and then we'll be moving towards uh, the mock debrief. So if you have any questions, just quickly ask me questions, and then I'll move forward. Well, we have swap and swaption, both are derivatives, but what's the difference between both of them? I said the swap and swaption, as you can see, swaption It's a merger of a swap and option. So swap means then when you have to swap currencies at both stages, in the initial stage and the later stage. But swaption gives you the option whether you want to swap it later on or not. When they sold their investments, they had to swap back. So it's a swap. But swaption means that if after 3 years they don't want to swap the currency back, they are free to do so. So they don't need to swap. So this is called swaption. So when is swap suitable to use? When actually it's not about when it is suitable, when it is available. That's the main issue, Simran. When it is available, it is usually available when there is a relationship between two companies, like parent and subsidiary relationship, where they know each other's requirement and they can find each other easily. So it's difficult to find a swap sometimes. No, we are not doing business finance today. I told you that the business finance videos will be uploaded soon. I've already shared the PowerPoint slide of business finance with all of you, and I will also share the video lecture on that. So let's move toward the money market hedge. Well, what is money market hedge? Well, we'll just explain it through an example. Examples for hedging a receipt. Now, in a money market hedge or in any hedging, you first need to find out whether we are hedging the risk for a receipt of foreign currency or we are hedging it for a payment of a foreign currency. Yashar, it was not about getting benefit. It was about eliminating the risk. They eliminated the risk. This is the biggest benefit that they have got from the swap. Both companies did not need to convert the foreign currencies. They just exchanged the currencies with each other, and their prime objective was to invest, and they did invest. Without converting the currencies. So actually you can say that instead of converting the currencies, they swapped the currencies, and they avoided the impact of the exchange rate by not converting. Okay, let's go for a money market hedge and assume that we are hedging a risk for a receipt. Let us read this question. A UK company expects to receive payment of US $800,000 in 3 months' time. It's very important. It wants to hedge this exposure to currency risk using money market hedge. Spot 3 months interest rates means the interest rate in the market for 3-month period are as follows. These are the rates in different markets for borrowings and deposits. The spot exchange rate, that is today, the current exchange rate in the open market is 1.9770, 1.9780 to US dollar to £1. So a company, it's a UK company, right? So for a UK company, the local currency will be pounds. So what do you think? Direct quote or indirect quote? Which quote is this? Is it a direct quote or indirect quote? Quick, be quick. Yes, it's an indirect quote because the company is a UK-based company, whereas the exchange rate is quoted in dollars. So it's an indirect quote, not a direct quote. Sikandar, it's an indirect quote. Dollar per pound. It's dollars per pound. It's $1.9770, not 1.99770 pounds. It's $1.9770, and the company is a UK company, so it's an indirect quote. Okay. Now, after 3 months, it expects to receive 800,000 US dollar, that is foreign currency. Simran, I will just explain it in a while. Do remind me of answering this question. So this company is going to receive 800,000 US dollars in 3 months' time. That is a foreign currency of $800,000. Now, what will be the concern for the UK company? Since UK company will be getting 800,000 US dollars, that is the foreign currency, in 3 months' time, it will be concerned about the value of the foreign currency going down. Now it wants to hedge this risk by using money market. What does it mean, using money market? Just watch and listen carefully. This company is supposed to receive 800,000 in 3 months' time. And what it will do with these 800,000 in 3 months' time, when it receives it, it will have to convert these 800,000 into UK's currency, that is pound sterlings. So it has to convert it into pound sterlings at the exchange rate of 3 months' time, which the company is unaware what it will be. That's the concern for him. That might fluctuate in a way that the company might be at loss. So what it wants to be relieved of the pressure of the exchange rate fluctuation. Now, how it can do so? What it is going to do is, since it is going to receive 800,000 US dollars, what it will do is it will just borrow present value of $800,000 from a US bank. Listen carefully and don't come up with any question at the moment. Just listen carefully. I will explain it and I will answer every question that comes in your mind. Just carefully listen. Borrows present value of 800,000 from US bank. Let's calculate the present value of 800,000 using the formula of compound interest. 800,000 into 1 plus, let's take the rate. What it is doing, it is borrowing. Remember, it is borrowing. What it is borrowing in dollars. So what we have to do is to take a borrowing interest rate of US banks. Let's go back to the question. We'll go for the borrowing rate and we will go for the US borrowing rate. This is the relevant one. So we'll just pick this rate at the moment because it's the borrowing rate of US. So borrows, so that's why borrowing rate. In dollars, that's why the US rate. So what's the rate? It's 4.250. Remember, these rate might be for a 3-month investment but are always quoted in annual terms. Remember this. These are for a 3-month investment. When you invest for 3 months, the annual interest rate will be 4.250. So don't get disguised with these 3 months. This is just to tell you that it's the annual interest rate for a 3-month deposit, for our 3-month borrowing. So it's a 3-month borrowing rate. So let's divide it by 12, by 4 to get a 3-month rate because we will be borrowing it for 3 months. So 4.25 divided by 12 to get a per month rate and multiply by 3 to get a 3-month rate. Can anybody give me the answer? 4.25 divided by 12 to get a per month rate and then multiply it with 3 to get a 3-month rate. 1.0625. It's in percent. Remember, it's a percentage. It's percent. So what we have to do, we have to divide it by 100 before we can put it in the formula, because we never put the figure with percentage. We divide it with 100. So divide it with 100. What do we get? Point 0.1625, right? At least 4 or 5 decimal places. So 0.01625. So I'll just put it here. 0.01625. Okay. Are we going to calculate the present value? Yes. What should be the sign of the power? Should be negative or positive? Should it be positive or negative? We're calculating the present value. 0.010625. I don't know. It's 1.0625, right? Okay, let me calculate it myself. It's 4.25 divided by 12 multiplied by 3. It will be a 0.1010. Yes, you're right. 0.010625. Okay. Okay, -1, because this 3-month period will now be considered one single period because we have put a 3-month interest rate in the bracket, so we'll never put it 3 here. We'll not put 3 here. We'll just put it -1. Remember, it will always be the case. So we'll put -1 because the whole 3-month period will now be considered a single period, as we have calculated the interest rate for a complete 3 months. Okay, what will be the value? Tell me the value of, what will be the present value of? I don't have a scientific calculator. It's 791,589. 791,589, right? Is it right? Okay, 791,589 is the present value. So what the company has to do is it has to borrow $791,589 from the US bank. And what it will do with that, it will convert it into local currency. Convert in pounds. Since it has borrowed it today, so it will use the current rate to convert it into pounds. So what's the current rate? We have been given 2 rates in the question. Remember, one rate, this is the rate, this is the rate. Which rate to choose? Remember, we will always choose a rate that will benefit the bank, because the bank always wins. So because the bank is going to make profit for these 2 rates. One of these 2 rates is a selling rate and the other is the buying rate for the bank. Okay, now we have to convert these 791,589. So 791,589. Now either we have to multiply with one of these rates, or we have to divide it with one of these rates. Remember a rule. Remember the rule. If you are going to convert in the same currency in which the rate is quoted, just multiply with the rate. And if you are converting in the other currency, divide it with the rate. So it's a simple rule. Remember this. Sometimes it will put you in trouble. You won't be knowing whether we should divide it or multiply it to convert the rate. There's a simple rule. Remember, multiplying with the rate if you are going to convert it in the same currency in which the rate is quoted, like it's US quoted rate. It's quoted in US dollars. And if you are to convert it in the US dollars, then you have to multiply with this rate. But if you are converting it from US dollars to pound sterling, then you have to divide it. So one thing's for sure, we are going to divide with one of these 2 rates because we are converting it from dollars to pound sterlings. So we have to divide. Now we have borrowed this from the US bank, and now we are converting it because we will be giving this currency to the bank to convert it into pound sterlings. So we will be selling the US dollars to bank against the pound sterlings. So how many pound sterlings are we expected to get against this? The bank will never pay you more. It will always pay you less. That's what I'm coming up with this. Waqas, I'm just coming up with this. So since we will be giving these $791,859 to bank against pounds, the bank will never give us more. So the bank will always give us less. So since we are dividing it, what do you think? dividing with a higher value will give a lower answer, or dividing it with a lower value to get the lower answer? What do you think? Should we be dividing it with the higher value to get the lower answer, or the lower value to get the lower answer? Yes, the higher value to get the lower answer, because bank will be paying us less, not more. So what's the higher of the two? It's 1.9780. So divide it with 1.9780 to get the pounds sterlings. How much do we get? Just quick, tell me how much we get. 791,589 divided by 1.9780. It's $4,00197 pounds sterlings. Okay. Now, today the company has 4,00197 pounds sterling in its hand. It will not keep it with it. It will invest it. Since it's pounds sterlings, it will invest in a UK bank for 3 months. At what rate? Let's go back to the previous slide. Are we borrowing this time, or are we depositing this time? Quick. Yes, we are depositing. And depositing what? Dollars or pounds? Pounds. So we'll go for the deposit rate, not for the US dollar. We'll go for the British pound. It's 6.5%. Now, 6.5% is actually annual rate. Divide it with 12, multiply it with 3 to get the 3-month rate. It's 1.625%. And divide it with 100 to get the value that we will be putting in the formula. It's 0.01625. Okay. So we will put it in the bank for 3 months at 0.01625. Okay. This time, are we calculating the present value or the future value? Yes, this time we are calculating a future value, as we have deposited it today to get something in the future. So we'll just write the power 1, and it's okay if we don't write anything as a power. So 1.01625 into 4,00197. So after 3 months time, this investment will have a value of 406,700 pounds sterlings. Kulan, deposit and borrowing mean that when you are investing, it's actually deposit. When you're taking loan from the bank, that's borrowing. So I don't know if this is what you're trying to ask. So these 406,700. Now listen carefully. What has actually happened? After 3 months time, remember, listen, so why we didn't divide it by 100? We have divided by 100. That's why we have got 0.01625. So we have divided it by 100. Okay. So this company will be having 406,700 pounds sterlings from this investment in 3 months time. Plus, it will also be having $800 that it was expecting to receive after 3 months time. Now the company will have 2 types of receipts, one from the deposit account and one from the customer, the foreign customer, of $800,000. But these $800,000, the company will not keep it. It will not keep this one, because the moment it receives these $800,000, it will have to pay this amount to the bank from which it borrowed the present value of these $800,000. After 3 months time, since the company borrowed this amount from the bank, after 3 months, this amount will be equal to 800,000, because it will now have interest in it. And since this borrowing will grow to 800,000, and the company will receive $800,000 from the customer, it will just straight away pay these $800,000 to this bank, and this liability will be settled from the foreign currency receipt. On the other hand, the deposit account will get matured, and it will have total of 406,700 pounds sterling. So what has happened to this company is that it will be having 406,700 pounds sterling instead of having 800,000 and converting them into pounds sterling. So after 3 months time, this company needs not to convert any foreign currency receipt. It will be straight away receiving 406,700 pounds sterling from the deposit account, and this amount is known at point zero, so there is no risk. It knows that it is going to receive 406,700 pounds sterling local currency, so it has actually hedged its risk through money market deposits, that is short-term deposit. That's why it's called a money market hedge, because it uses short-term deposits and borrowing to hedge the risk. So after 3 months time, no need to convert foreign currency receipts. It will straight away be paid to the borrowing account, and the mature value of the deposit account will be in the form of the local currency, and the company needs not to have any conversion after 3 months time. So I hope everybody has got this. Yes, instead of receiving $800,000, we are going to receive 406,700 local currency. And why I say the risk has been eliminated, because at point zero, we have calculated what we are going to receive after 3 months time. So we are sure of receiving 406,700 pounds sterling from the deposit account. Arslan, do you really think it can be quickly explained? Okay, let me try to explain it quickly. Let me try to explain it quickly. Mr. A is expecting to receive $800,000 after 3 months time from a foreign customer. And if he does not hedge this risk, he's not sure after 3 months when he will receive these $800,000 how much in local currency he is going to get, because it has to convert it at the rate prevailing in the market after 3 months time. So he's not sure of what the rate will be. So instead of waiting for the 800 receipts for 3 months time, it can go for a money market hedge. And what is it? Well, it will go to a US bank. It will go to a US bank and borrow present value of 800,000, because it knows that after 3 months time, if he borrows 791589 today, this amount will grow to $800,000 in the future. And once it grows to 800,000 in 3 years time, it will receive 800,000 from the foreign customer, and he will be able to pay to this bank these $800,000. So he borrowed the present value. He will borrow the present value of $800,000. That is 791589. Because it is in dollars, it has to convert it into local currency. So it will convert it into local currency using the relevant exchange rate we have already explained. So we'll take the relevant exchange rate to convert dollars into pound sterlings. So by exchanging these dollars into pound sterling, he will get 400,197 today, and he will invest it for 3 months at a rate at a deposit rate of at a UK deposit rate of 0.01625. So it will invest it for 3 years, and after 3 years this amount will grow to 406,700 pounds. So after 3 years this amount will get matured and will be converted into $800,000, and the foreign receipt will be enough to pay this liability. So the $800 received after 3 months time will be used to pay off this liability which he borrowed. But after 3 months time, his deposit account will also get mature, and it will have 406,700 pounds sterling after 3 months time. So the company will be holding local currency after 3 months time instead of foreign currency. So this was the case for a receipt. So for the payment hedging, It's your home assignment. Go and do it at home. Uh, it will be totally reverse. Instead of borrowing the present value of foreign currency, you will have to make a deposit equal to the present value of the payment. So you have to make deposit in the foreign currency first. And to make this foreign currency deposit, you have to borrow in the local currency today. And after 3 months, after 3 months, you will have to pay out of the foreign currency amount, that foreign payment, and you'll have to pay a local currency to the local borrowing account. So just on the next slide, you have the question for hedging a payment. So just go for it. And if there's any problem, you can ask me on the WhatsApp group. So this was exchange rate risk. We're done with it. As far as the interest rate risk is concerned, I will share the interest rate risk handout with all of you. Most probably tomorrow. You will have almost all of the video lectures on YouTube, and you will also get the slides for risk management as well. So we are done with that, and let's take a 10 minutes break. Let's take a 10 minutes break, and after the break, we'll be discussing the mock exam. So let's take a 10 minutes break. We'll be back at it's 3:10 Pakistan time. So note down your time and come back after 10 minutes. Well, Sheila, I'm just sharing my number. Mariam, I guess you also asked my number. And Sheila, I'm just sharing my WhatsApp number with you. For anyone outside Pakistan, 0092 321 2604033. And for someone in Pakistan, it's 2604033. So add me on the WhatsApp. Just text me on the WhatsApp, and with your name, I will add you on the WhatsApp group. Sana was working capital's lecture will also be uploaded tomorrow. So just come. Yes, I said 3:12. So add 10 minutes in it, and we'll be back in 10 minutes. So no more questions. Hello everyone. Can you see the question paper on your screens? Can you people hear me? Okay. Let's start discussing. This mock exam might have a few areas that were not covered in the webinar, and so we'll leave those areas of the paper because for that we need explanation of the topic as well. So once you people watch those videos of the rest of the topics, uh, then come back to this mock again, solve it, and we will discuss it later on the WhatsApp group, or we can have a Skype session as well. So let's start it from the very first question, section A of this, and question number 1. Well, remember one thing: never start question from here. Always start it from here. Remember to start it from here. Do not start from the information contained in the question. Start from the requirement. What is the minimum price per share which the owners should accept for the company? So it's a business valuation question. So what reading requirement first does is it helps you isolate the specific area from the syllabus. Now we know that it's just a business valuation question, so we don't need to recall any other area. So we just need to focus on the business valuation area. What is the minimum price per share which the owner should accept for the company? Let's read this question. The owners of a private company wishes to dispose of their entire investment. It's a private company. Remember, it's a private company, and I've told you. And they have asked for the minimum price. So for a private company, what is usually the minimum price? We have discussed in the business valuation. The minimum price for a listed company should be the share price of the market, and for a listed company, it should be the share price of the market, and for the unlisted company, which is this private company, it is what's the minimum price for a private company? No way, Taha. Anyone else? Yes, Arslan, you're right. It's the realizable values of the assets. Come on. It's the realizable values of the assets. No private business will sell its business for less than the value of its investments, for the value of the assets that it has. So the owners of a private company wish to dispose of their entire investment in the company. The company has an issued share capital of 1 million of 0.5 million nominal value. The owners have made the following valuations of the company's assets. So the non-current assets at book value are equal to 30 million, the current assets 18 million, non-current liabilities 12, and the current liabilities 10. We need to calculate the price of the share and not the whole company. Huh? So we need to find out the value of equity actually per share. So let's first calculate the total value of equity. The total value of equity will be the total value of the assets minus the values of debts. So 30. Remember, this is book value, and we have to take realizable value. So forget about the realizable value first. Just we should write the book values. The current assets 18 million. Okay. Now we have written the total cost, total value of the assets, but these are the book values. Now just read this phrase: the net realizable value of the non-current assets. The net realizable value of the non-current assets exceeds their book value by 4 million. So that if it's 30 million, the book value is 30 million, then the net realizable value will be 34 million. So of the 34 million, 30 million have already been included, so we just need to add 4 million further. to take this book value to the realizable value. The current assets include 2 million of account receivable, which are thought to be irrecoverable. So you won't be able to realize 2 million out of 18 million. So we have included 18 million, instead we should have included 16 million. So we'll just reduce it by 2 million. So now we have got the total realizable value of assets, not the equity, it's the total value of realizable value of assets. Can you add all these? What should be the answer? It's 50 million. Okay, thank you. Now we need to reduce it by the liability figure to get the value of equity. So minus 12 plus 10, 22. The total value will be 28 million. 28 million, I guess. Okay. Total liabilities, it will be 12 plus 10, 22 million. 18 million. How come you can say it's 18 million? Oh yes, it's 18, it's 22 million. So 28 million is the total value of equity. Then we have to divide it with the number of shares to get the per share value. So how many shares the company has? It's 1 million shares. So we just divide it with 1 million. So the above figure is already in millions and the number of shares in millions. So it will be $28 per share. So the answer is C. So the right answer is C. Oh, I'm sorry. I've just written the dollars value of the share capital. Instead, we should be having the number of shares. Sorry, it's not 1 million. The total par value is 1 million, and we need to divide it by 0.5 to get the total number of shares. Yes, it's 2 million. Okay, we'll divide it with 2, and the answer here will be 14 million. I'm sorry, I just took the dollars value. Okay, it's 14 per share. So it's 14 per share, and the answer is A. So any question? Will we get a link to the videos recording? Yes, you will get it. Yes, you will get it. And we also have a WhatsApp group, and I will share my contact details by the end of the session, and you can add me on the WhatsApp as well. So yes, Taha, I will upload. I'm already done with the one of the lectures. I just need to upload them, so I will do it. Okay, let's move forward to the next question. Which of the following financial instruments will not be traded on the money market? So it is asking about the money market, so it should keep this in mind, and it's saying not traded. So this is very tricky. In most of the questions, you will have negative statements which we at times might ignore. Okay, now just remember, money market is a short-term market. The key here is to find out which of these are long-term. So it actually wants us to pick the long-term investment securities. So which of the following are long-term? Well, which of the following? What do you think about the convertible loan notes? Convertible loan notes. Loan notes are short-term investment securities or long-term securities? These are long-term securities. So it has nothing to do with money market. So the answer will be B. It will be B. Simple. So sometimes you don't need to go through all the options. So you have to pick the question, the trick in the question. So this is the trick in the question was to pick the long term. So the convertible notes are the long term one and nothing to do with the money market. What's commercial paper? Well, commercial papers are short-term securities issued by corporations to finance its short-term investments. Why not D? D, certificate of deposits. Certificate of deposits, Aisha, these are the short-term investments, and they are short-term borrowings, and short-term borrowings are dealt in money market. Let's move towards next one. Andrew Company is a large listed company financed by both equity and debt. In which of the following areas of financial management will the impact of working capital management be smallest? Well, since we haven't studied the working capital management, but it's a very simple general question, that's why we're discussing it. I cannot see you. Yes, there's some problem with the video, so I don't think there's any requirement for the video. So can you see the screen, Rishab? Can you see the screen? I hope you will see me once the problem is fixed. Let's go to the question 3. It's a very simple working capital general question. That's why we're discussing it. Andrew Company is a large listed company financed by both equity and debt. In which of the following areas of financial management will the impact of working capital management be smallest? It's not saying there will be no impact. It's saying the smallest impact. Now, liquidity management, like cash management, and working capital is the management of short-term investments. So liquidity management is one of the key areas of working capital management. We have interest rate management, definitely working capital. To finance a working capital, you will sometimes go for short-term investment, and to go for short-term investments, short-term borrowings, you have to have a connection with the interest rates. So management of relationship with bank, it's very important in the working capital management to have very good relationship with the bank, because you will be needing finance from the bank, and if you don't have good relationship with the bank, then it will put you in difficulty. So in working capital management, you always need to have a good relationship with the bank. As far as the dividend policy is concerned, again, the working capital management will affect the dividend policy, but it will affect it in the least way. Simran, we haven't discussed working capital management. I will upload the videos, but working capital management is actually how do we finance our short-term investments, and how much of the amount we should invest in short-term investments, like cash, like account receivable, like investment account receivables. So this is all about the working capital management. We haven't studied it yet, but I will upload the video of the working capital management tomorrow, and then you'll be able to solve these questions. So for the time being, it's dividend policy, which is least affected by the working capital management. What is meant by B and C? B, interest rate management. Well, working capital management means, say for example, if we need a working capital of say $10,000 to run our business. Now, what we have to do is to find out an appropriate source to finance this. We might go for a short-term loan, we might go for overdraft, we might go for any other short-term borrowing, but that every short-term borrowing will have interest rates attached. So we have to manage interest rates so that it costs us less to borrow $10,000. So working capital management, the interest rate management is one of the areas of working capital management. Well, dividend policy, what is dividend policy? How much dividend you want to pay to your shareholders? This is called your dividend policy. This depends on your dividend policy. If you pay all of your profits at dividend, you won't be having uh, enough reserves for further investments, for future investments. But if you don't pay dividends, it will give negative signal to the investors. So you have to create a balance between paying dividends and retaining profits. So if you pay all the dividends, you may have little to invest in your working capital. So working capital management has to do with the dividend policy, but it is not asked that what is totally irrelevant. It is just asking which of these four will have the lowest impact. And this is working capital, because this is dividend policy, because dividend policy is usually uh, for mainly for other factors like keeping money for long-term investments, satisfying our shareholders by paying more dividends. So it mainly has long-term impacts rather than short-term impacts, but it still has something to do with the working capital management. It is not totally irrelevant, but all we have to had to do was to pick the one which has the smallest impact. So all the three above three are have more impact of the working capital management. Yes, Rishab, there is a connection of dividend policy and working capital management, but if we compare all the four, it will have the least of the impact. Which of the following descriptions, which of the following are descriptions of basis risk? Now let me first explain what is basis risk. Basis risk, we discussed futures, right? In our yesterday's lecture, and I told you that uh, the exchange rate in the open market, say for example, if it's rupees 100 per dollar in the open market, it will be different in the futures market. Say it will be 101 per dollar, suppose. And after 1 month, if the open market exchange rate goes to, say, for example, 102 per dollar, not necessarily in the future market it will go up in the same way. It might behave differently. Say, for example, it might go up by 103 per dollar. Just assuming figures to explain my point. So if you see that the movement here is different and the movement in the futures market is different. So what will happen is that you might lose more in the open market and gain less or more in the future market. So there is always chance that the gain from the future market may not offset the loss in the open market, and you may not end up in reducing your risk completely. You can eliminating your risk completely. So this movement, this is called, these are the basis points movements. That there is two, you can say the two rupee movement in the open market, where there is different, say it's not 103, it is the same. Say it has moved by to 105. I'm just assuming the values. So there's 4 rupee movement in the future market, whereas there's only 2 rupee movement in the 2 rupees movement in the open market. So this movement in the exchange rate in the future market or the open market is called the basis risk. So the risk is that the open market may change differently than the exchange rate in the future market, and you may not be able to offset your loss completely. So this is called the basis risk. So this is called basis risk. Now let's read these points. Let's read these points and tell me which option do you think is the one. This is for the exchange rate, right? Now we have a So what's the answer? What do you think was the answer? Okay, let me read one by one. It is the difference between the spot exchange rate and the currency futures exchange rate. Is it right or not? It's not right because it's not the difference of the exchange rate in the open market and the exchange rate in the future market. It's actually the movement in the exchange rate versus the movement in the future market rate. It's not the mere difference of what is the exchange rate in the open market and what is the exchange rate in the futures market. It is the movement in the open market exchange rate and the movement in the futures market future market rates. So if the movement in the open market exchange rates is different than the movement in the futures market exchange rate, that's called the basic risk. So it's not correct. It is it is the possibility that the movements in the currency future price and the spot price will be different. Is it correct or not? Do you think it's right? Yes, this one is correct. It is the difference between fixed and floating interest rates? No. Is it one of the reasons for an imperfect currency future hedge? Yes. Okay. The correct option is now C. Yeah, Taha, we've got 2 marks. Okay, let's move forward. Well, Craig has sales of 200 million per year of gross profit finished good inventory. In relation to goods inventory and assuming 360, how much finance will be needed? So it's actually working capital management. So just skip it for the time being. And once you're done with your working capital management lecture, do come back to this question, solve it, and if there's any problem, just share this question on the WhatsApp group, and I will come up with the answer and explanation. Simran, since we haven't discussed the working capital management yet. So I don't want to get into that because it will take so much of our time to explain, because I have to explain the basics. So just move on. Let's discuss the topic that we have already discussed. Once you're done with your working capital management lecture, solve this question and put this question on the WhatsApp group. I'll come up answering that. Okay, let's look at this. No, I haven't uploaded it yet. I will be uploading it tomorrow. So on Sunday, you will be having most of the lectures uploaded. You'll have most of the lectures uploaded. Just look at the question 6. In relation to an irredeemable security, paying a fixed rate of interest. For example, you may have irredeemable debentures. Paying a fixed rate of interest. Which of the following statements is correct? As the risk rises, the risk of default rises, the market value of the security will fall to ensure that the investors receive an increased yield. Yield is the total return that an investor gets on its investment. So it's the total interest that it gets. So it's the interest plus the difference between the issued value and the redemption value. So it's the total what an investor gets against his investment. So as the risk rises, the market value of security will fall to ensure that investors receive a reduced risk. As the risk rises, the market value of security will rise to ensure that investors receive an increased risk. As the risk rises, the market value of security will rise to ensure that investors receive a reduced yield. Now let us explain. Remember, whenever there is high risk, it is usually compensated against higher return. If I'm an investor and if I perceive more risk in an investment, it means I will need more return. And remember this security, it has fixed rate of interest. So no matters how much risk increases, this security has to pay at a fixed rate of interest. Say for example, it will pay 6%. It will never change because debentures will have a fixed rate. So whatever risk uh, of default is in the future, it will not affect this rate. But since I'm an investor, if I see that there is high risk and it's a tradable security, so for any tradable security, if risk increases, it cannot adjust this risk in the interest rate. It will adjust it in the market value. So the market value has to go down. If it had a market value of $100 and the company is paying 6%, that is $6. If the risk goes up, this can't be changed. It will still be applied to the par value, but the market value will go down. Say for example, it might go down to $90. Now if an investor gets the same $6 against a value of 90, automatically in percentage terms it will increase. Yes, debenture usually pay higher rate. So to compensate for the higher risk, the interest rate cannot change. So it is the market value that has to change in order to compensate for that higher risk. So now just read these 4 points and come up with the answer. What do you think should be the answer? A, sir, as risk arises, the market value of security will fall to ensure that investors receive an increased yield. Yes, it's the A. Good. And if the risk reduces, the market value will go up. And let me explain it in another way. Say for example, you're going to buy a car. You're going to buy a car, and you decided to buy it for $10,000, and all of a sudden you came to know that there's a risk that the car might need a repair or might need some working on it. So how will you compensate for that? You'll just be now you won't be ready to pay the same $10,000. You have to reduce its value to compensate for that. So if you're going to buy a security which is giving you a fixed interest rate, and you see that the interest the risk has gone up, the company is getting a high gearing by acquiring more and more of debts, then you can't change the interest rate of the debt because it is fixed. So all you can do is reduce the value of that debt. The value of that debt will go down. So A is the right option. Let's move towards 7. It's again working capital, so we'll just leave it for now. In relation to an operating lease, it's a business finance question. Again, once you will watch that lecture on business finance, it has detailed features on different types of sources, including the operating lease. And once you are done with that lecture, you'll come back to this question and you will be able to solve this question. Now let's question number 9. It's what is the theoretical value of the company? Business valuation. When we are already done with this, so we need to calculate this. A company has an annual tax operating cash flows of $2 million per year, which are expected to continue in perpetuity. It will continue in perpetuity. The company has a cost of equity of 10%, before tax cost of debt of 10%, and an after tax cost of capital of 8%. Corporation tax is 20%. What is the theoretical value of the company? Just quickly tell me which model we will be using. Which model should we be using for business valuation here? It's not CAPM. Do you have risk-free rate of return, Taha? Do we have the risk-free rate of return? Do we have equity beta in the question? Do we have a market return? We don't have anything for the CAPM, so we can't use. And CAPM is not used for business valuation. It is used to calculate the cost of equity. Yes, Simran, you are right. We'll be using. Oh, come on, price-earning ratio. Where is the price-earning ratio in the question? You need to understand the business valuation question from the information given. There's the only information in the question is regarding the cash flows. You don't have any price earning ratio, don't have EPS in the question. So you can't use price earning ratio. So we'll be using the cash based model. So we'll be using the cash based model, remember. So cash based model, all we have to do is to calculate the present value. In a cash based model, I told you that we need to calculate the present value. Since it's a perpetuity case and we all know how to calculate the present value of perpetuity, do you remember? Yes, Simran, I'm explaining it. In cash based model, all we have to do is to calculate the present value of all the cash flows arising from the acquisition of the company, the way we do it for purchase of machinery. So we have a formula, NVT divided by discount rate. This is the NVT that we're going to receive, 2 million divided by discount rate. Okay, tell me, what discount rate should we use? Should we be using the cost of equity, cost of debt, or cost of capital? I told you, in a cash-based model, what we use cost of capital, weighted average cost of capital. Remember, yes, WACC. So we'll divide it with 8, multiply it with 100 to get the present value of all cash flows. And what's the answer? 25 million. Yes. Simran, if they give profits, then we can use profit-based measure like price earning ratio. For that, we need to have a price earning ratio of an industry or of a similar company. But in this case, they have clearly mentioned these are the cash flows, so we need to use cash flow base. We never discount profits. Remember, we need to have cash flows in order to calculate the present values. So the answer is 25 million. Let's move forward. Which of the following would you expect to be responsibility of financial management? Do you really think a financial manager has responsibility of producing annual accounts? Quick, yes or no? No. Okay, do you think they will be producing monthly management accounts? Do you really think they will be advising on investment in non-current assets? Is this the responsibility of a financial manager to? Yes, right. So we can only tick one. So we don't need to read the D1 because we already have got the right one, but we'll still read it. Deciding pay rates for staff. No, it's not the responsibility of a financial manager to decide the pay rates for the staff. So let's move to question number 11. What is the current market value of Lane Company? Convertible loan notes. We've already done this, so let's do it quickly. You know that the present value, the market value of any debt is actually the present value of the benefits that we are going to receive from it. Since it's a convertible loan, what is the first step that we are supposed to do? It is to know whether the investor will be converting this loan or it will be redeeming it, right? So we need to calculate the conversion value. How many shares are we expecting? Each loan note can be converted in 5 years' time into 25 ordinary shares. So 25 ordinary shares. Okay, what's the current share price? The current share price of Lane Company is 3.6. Will it grow? Yes, it will grow. It will grow at 5% for 5 years. So we'll write 1.05 raised to the power 5. Okay, just do the calculation. It's 25 into 3.6 into 1.05 raised to the power 5. So it will be $115 approximately. So the investor will have two options after 5 years: get shares equal to 115 or redeem it at par value, $100. So definitely he will not go for redeeming it, it will go for conversion. So what we need to do is to calculate the present value of the interest payments and the conversion value. What interest payments are we expecting from this loan? Just look at the rate of interest. It's 3%. It's 3% convertible loan notes. So we'll just take 3%. Remember, there is a tax rate given in the question, but the cost of debt is before tax. So what we'll do is we'll just ignore this tax rate. will not incorporate this tax rate into our interest payments and will not incorporate in the cost of debt. So we'll just simply ignore it in both areas. So just take 3% means 3% of 100, that's the par value, $3. Can anybody tell me the annuity factor for 10% for 5 years? Well, Rashab, we for business valuation purpose, if the interest payments are before tax and the cost of debt is also before tax, we just simply ignore it. We don't ignore it. We ignore it and do not incorporate anywhere. Three, right? 3 into 3.791 plus the present value of 115. Can anybody tell me the discount factor for 5 years at 10%? Okay, 0.621. Just calculate. So what's the answer? It's 81.552 or it's 82.71, or what's the right answer? It's 82.79. Okay, it's 82.79, approximately 82.71. This is the right answer. Okay, let's move forward. According to the four-way equivalence model, so repeat why we ignore tax rate. Well, what we do is in a business valuation question, if the interest payments are before tax and the cost of debt given in the question is also before tax, so it means the question wants us to ignore the tax. That's why it has given us all the figures before tax. So do not incorporate tax anywhere in the question. The four-way equivalence model is actually the model used in the exchange rates, and what it says is, it says that suppose that we discussed the interest rate parity theory, IRP. We discussed the purchasing power parity theory. And we discussed the Fisher effect as well. And simply the four-way equivalence model says that whether you look at from the purchasing power parity angle, that is the inflation angle, whether you look at from the interest rate angle, or you look at from the Fisher effect, the difference in the exchange rate by and large will be due to the same reasons, and the main reason behind is the inflation rate, which changes the interest rate, which changes the due to changes in the interest rate, it changes the forward rate, it changes the future spot rate, it changes the expected spot rate. So the four-way equivalence model is actually saying that the main reason of exchange rate movement, if you look at from any angle, is the inflation rate, which changes the forward rate and changes the spot rate as well. So that's the main theme behind the four-way equivalence. Now just all you have to do is just ignore the four-way equivalence at the moment. Just you can solve it without it. by applying the interest rate parity theory and by applying the forward rate purchasing power parity theory. Just we have to prove which of these three are true. Which of these three are true? Number one, company's X nominal interest rate should be 7.06 per year. It is asking for a nominal interest rate. What are the exchange rates? Country X uses the dollar as its currency and country Y uses the dinar. So the country X has a currency of dollar and the country Y has dinar as its currency. Country X expected inflation rate is 5%. So the inflation rate in country X is 5% in one country compared to 2% per year in country Y. Country Y's nominal interest rate is 4%. Now all you have to do is to calculate the country X nominal rate. Yes, Simran will be doing section A only, and I will share the timing for discussing the section B and C on the WhatsApp group. So just all you have to do is to calculate the nominal rate for country X and see if it's 7.06. If it's 7.06, it means it's a true statement. No, it will not be different. It will not be different even if you for the timing you ignore this 7 equals. All you have to do is to calculate the nominal interest rate for company X and see if it's 7.06. If it's 7.06, it's okay. You know the Fisher effect. You know the Fisher effect. You know the formula of the Fisher effect. We discussed it yesterday. So just put the values in the Fisher formula and try to find out the value of country X, the nominal rate of country X. So if it's 7.06, it means it's true. So I'm not going into the calculation. I've just given you a hint. Okay, it's 7.06, so it means it's true. The future spot rate for after 1 year should be 1.4571 dinar per dollar. Now, and just recall the previous day's lecture. Which formula do we use to predict future spot rate, the expected spot rate? Do we use interest rate parity theory or purchasing power parity theory? We use purchasing power parity theory exactly, because to calculate forward rate we use interest rate parity theory, but to calculate future rate we use purchasing power parity theory. So just use purchasing power parity theory to calculate the exchange rate. If it's 1.457, it means it's a true statement. And then country X real interest rate should be higher than that of country Y. And in previous lecture, the interest rate parity theory suggests that the real rates in every country will be same. It's the inflation rate that makes the difference. So the statement 1, according to you, all of your calculation is true. Yes, okay. Statement 2 is also true, but this is not true. The real rates, according to the theoretical perspective, will always be same in every country. It's the nominal rates that make the difference, and nominal rates are different because of the inflation rates. Yes, IRP is used for predicting the forward rate, not future forward rate. It's just a forward rate. If you want to have a forward contract today with any bank, the rate that the bank will fix today for a future transaction will be the forward rate. So it's not a future forward rate. Forward rate is fixed on the same day for a future transaction. You can say this. Which of the following government actions would lead to an increase in aggregate demand? This question is actually linked with the chapter 1 and chapter 2 of the syllabus. So just first go through chapter 1 and chapter 2. It's just a theoretical area, and it is about the financial management function and about the financial management environment. So this area will be in the financial management environment. That is the micro and macro economics of the country. So just go through that section and you will be able to solve this. Okay, what is the Pete's return on capital employed? Just need to calculate the return on capital employed. Return on capital employed is equal to your profit before interest and tax divided by capital employed. And capital employed, you all know, it is the sum of equity plus long-term debts. So what's the return on capital employed? What's the profit before interest and tax? It's 2,500. And what's the sum of these two? What's the answer? 20%. Okay. So 20% is the answer. C. Sir, MV forward, please. What's this? Simran, what are you saying? Okay. What's the theoretical value of a right per existing share? We've done it yesterday. So let's quickly calculate. Just quickly calculate the theoretical value of a right per existing share. Remember, it's not the theoretical X right price. It's the value of right. And you know the formula. I told you the formula yesterday. Let's first calculate the X right price. Well, what's the right issue? 1 for 4. Okay, 1 for 4. One new share for 4 existing shares. What's the price of the existing share? Right issue at 6 per. What's the existing share? Its share price on the announcement of the right issue was 8 per share. So it's 8. 4 into 8, 32. And the new share will be issued at $6. That's 6. The total value will be 38. And it will be shared by 5 shares equally. So 38 divided by 5. What's the theoretical X right price? Is it 7.6? Okay, thank you. Okay, remember the question has not asked for the theoretical X right price. It has asked for the value of right per share. And what's the formula? I told you the formula last day about how to calculate the X right value of right per share. Remember, it's the difference between the price before the right issue and the theoretical X right price. So before the right issue, the price is 8 and it will go down to 7.6. So the value of the right will be $0.4. B. I hope you've got it. So I will just try to have another session with all of you on Skype, probably on Monday. And tomorrow, what you have to do is to go and watch the video lectures on working capital management and business finance. And once you have watched that, go through the rest of the questions. Go through the rest of the questions. Go through the rest of the questions. And once you're done with the rest of the questions, we'll discuss it on Monday. Yes, Sundas, it will be done on it will be done tomorrow, and maybe one of the videos are uploaded today, and maybe the rest are uploaded tomorrow. Yes, Sikandar, I will try my level best to upload it as early as I can. And just go through the rest of the questions once you're done with that video lecture. And everyone else who is not on the WhatsApp group yet, just text me on my WhatsApp so that I can add you on the WhatsApp group, because from now onwards my communication with all of you will be on the WhatsApp group. So it's 00923212604033. And I hope the session was useful. I tried my level best to cover as many things in this limited time as possible. And I hope you people liked it. And just a quick feedback from all of you. How will you rate this session from 1 to 10? Kindly, I just want to know. I'm talking about the overall session, Sikandar. No, I'm also teaching F5 as well. Yes, it was really challenging with the timing, but uh, of the session, I will be with you people, and I'll be helping you people through till your exams. That's well, Yesha. No, I'm not reading your name right properly. I haven't taught the online session for F5 in study school. I've just told you that I also teach F5, so I was not on the F5 panel. Well, Savandi, I can't pronounce your name. Well, you can note down my number and just text me on the WhatsApp. I will add you to the group. Actually, the link of the WhatsApp group is not working, so just add on your screen. I have placed my number. I've just placed my number on the screen. All you have to do is to text me on the WhatsApp. I will just add, with your name. I will just add you to the WhatsApp group. Thank you, Sikandar, for the nice comments. And I know I didn't come up with your plan, but I will do it. I'm sorry for that. Rishab, I can't see your query. Can you just repeat? Because there are so many messages, I just missed it. Well, Rishab, you have to use pen if there is any graph. You have to use pen. You can't use pencil throughout your paper. You have to use black ballpoint, and you can't use any other color pen during your exams. Yes, Mariam, I have a F5 group on Facebook. Just add me on the WhatsApp and ask about the group. I will just share the link with you for that F5 group as well. Thank you, Jonathan. And thank you, everyone, for rating me so high. And Simran, you can only use black ballpoint in the exams. You can't use ink pen or anything else. You just need to use ballpoint in the paper-based exam and make sure the ink does not spread on the paper. That's the only issue, because they have to scan all the copies and send it for checking. So Plan how to get 50 marks. To get 50 marks, you need to set a target of more than 80. So first thing is to set your mind in such a way that the target should not be 50. It should be well above 50. Well, if you draw it by pencil, you will lose marks. If you draw it by pen, you won't lose any marks because this is the requirement of ACCA. You have to use black ballpoints. You can't use any other pen. Okay, guys, I think this session is over now. If you have any questions, just drop a message on the group or on my WhatsApp number, and I'll respond to all of your questions. I think I should end the session here, and we'll be in touch. But best of luck for the paper, and I hope all of you uh, get more than what you expect from yourselves. And best of luck. Bye bye. Take care.